No small business owner wants to be contacted by the IRS for an audit. It takes up a lot of time. The business may have to pay a CPA to represent the business during the audit, and the business could potentially owe more taxes once the audit is over. No matter what, any business can be selected for an IRS audit, but here are 10 IRS audit red flags and triggers that could put your small business at a greater risk of being audited. 1. The foreign bank accounts and assets audit risk. Foreign bank accounts and assets are high on the list as an IRS audit trigger. If you have a small business, it's probably not doing business on an international level. So if your business has a foreign bank account or assets, the IRS might question why your business would need to use foreign accounts. The IRS knows that foreign banks can be used to shelter income from taxes, and the IRS is not going to tolerate it. How would the IRS even know about your foreign bank accounts or assets, you ask? Well, non-U.S. banks are supposed to give reports to the IRS for accounts that are over $50,000 that are held by Americans. Also, the IRS requires you to report foreign bank accounts and assets for any amount over $10,000. If you don't disclose this information and the IRS finds out later that your business does have a foreign bank account or assets, then your business is almost guaranteed to be audited by the IRS. 2. The lots of zeros or multiples of 5 audit risk. If you have a tax return with income or several deductions that end with zeros or 5, it's an audit trigger because it could indicate that you are estimating or guessing at numbers. Please never guess or estimate your numbers. Some tax advisors say that guessing is okay, but if you're audited, the auditor won't trust your amounts and might decide to look more closely at most or all of your income or deductions. Typically, the only time an auditor will accept an estimate is if it is obvious that the expense actually happened. Even then, the auditor will make the final allowed estimate, and more than likely, it will be less than your estimate. Now, if it just so happens that your income or your deductions really end in 0 or 5, don't change your amounts just to try to avoid an audit trigger. Just make sure that you have good documentation to support it. 3. The underreported income audit risk. Cash is king and the IRS loves the king. A cash business is an easy audit trigger because the IRS knows that a cash business can forget to report all of their business income. A few examples of cash-based businesses are beauty and barber salons, restaurants, and cannabis shops. If you operate a cash-based business, please make sure that you keep really clean records and documentation because you have a slightly higher chance of being audited by the IRS. The IRS knows the income and deductions that are typical for your industry, so they are expecting your income to be in a certain range. And that leads us to our next IRS audit red flag. 4. Your deductions are too high audit risk. Have you ever wondered why you are asked for an industry classification code on your business tax return? Well, one of the reasons is it's used to compare your income and expenses to other companies in your industry. When I was an IRS auditor, I would prepare a spreadsheet comparing the expenses for a business against the industry average. It is an audit red flag when your business has big differences in income and expenses when compared to others in your industry. This is not to say that your business is not allowed to be out of line with others. It's just the IRS might want you to explain why your amounts are out of line with others in your industry. You have to keep in mind that your business can only claim deductions that are ordinary for your industry and necessary for your business. For instance, if you fall into the trap of writing off your daily meals and that is not the industry norm, your deduction for meals would be higher than the meals deduction of other businesses. Take plumbers, for example. On average, plumbers as a whole probably don't deduct a lot for meals on their tax returns. So, as a plumber, if you deduct your daily meals, your meals deduction will be higher than the industry average, and this could be an audit red flag. 5. The claiming business losses year after year audit risk. Business losses aren't unusual, but claiming losses year after year is an audit trigger. Not making a profit is an audit trigger because your business might start to look like it doesn't have a profit motive. And the IRS requires your business to have a profit motive to take deductions. If you don't make a profit 3 out of 5 years, the IRS might contact you to try to get a better understanding of your business. I know you don't want the IRS to start poking around and asking questions. So, if your business is claiming all kinds of random expenses just to claim losses and avoid paying taxes, you might want to rethink your tax strategy. Although I'm a firm believer in taking every deduction that you can legally take, I don't believe in gambling and taking a risk by trying to force your taxes down to 0. With that being said, if you stand behind your expenses, please just make sure that you can explain why all of your expenses are ordinary and necessary. 6. The income and expense fluctuations audit risk. If your business has been established for quite a few years, the IRS expects your income to be somewhat in the same range from one year to the next. It's expected that you will have slight increases and decreases, but dramatic changes can be an audit trigger. The IRS uses automated software to monitor the fluctuations in your income and expenses over the years. And now that the IRS is using AI, it's becoming even easier. The software will generate a list of potential businesses to audit based on these fluctuations or other audit triggers. Then the list is given to different audit teams to do a manual review. The assigned auditor will compare your income and expenses from year to year. Sometimes the auditor might feel that your business tax return is not worth auditing, but if you're contacted by the IRS, please just be prepared to explain any fluctuations. 7. The net operating losses audit risk. Using a net operating loss carry forward on your business return is an audit red flag. A business is allowed to use loss carry forwards, and it's definitely not a big deal. What the IRS is worried about with a carry forward is calculation mistakes. Sometimes when a business uses all or part of the net operating loss carry forward, there are calculation mistakes that happen due to keeping track of the losses over the years. Sometimes a different person will do the calculation from one year to the next, or maybe a business will change tax preparers. IRS auditors know that these type of changes can lead to an audit adjustment, so usually they will examine your carry forwards. 8. The independent contractor's audit risk. On a basic level, if your business can control what and how a person does a job versus just being able to control the job results, that person should be classified as an employee. If you're issuing more 1099 forms than W-2 forms each year, that's an audit risk. The IRS is aware that a business might prefer to classify workers as independent contractors to avoid paying payroll taxes. When I was an IRS auditor, we worked in the same area right there with the employment tax auditors. When we thought that there could be an employment tax issue, including independent contractor classification concerns, we would pull the employment specialist into the audit too. So now the business would have two separate auditors working the case. The IRS employment tax auditor would dig a little deeper to determine if the person is actually an employee instead of an independent contractor. Your business should always document by job in detail what services a contractor performed and the dates and times. Now, of course, if you have contractors who are really employees, you can avoid this audit red flag by making sure to classify workers as employees. 9. The late payroll taxes audit risk. For a small business, this is a big one. The IRS actively looks for this. If your business is in the habit of filing payroll taxes late or not at all, that's an audit trigger. Employment taxes are a big deal because you have already withheld the money from the employee's paycheck. Now, not only is your business at a greater risk for an audit, the person or people in charge of paying the payroll taxes for your company can have criminal charges filed against them. And yes, these people can end up serving prison time. The IRS has increased the number of audits for employment taxes, and at least 70% of the time, really bad cases will result in a prison sentence. Out of all of the audit risk on this list, please avoid this one at all costs. Whatever you do, do not let your business get behind in paying payroll taxes. 10. The home office deduction audit risk. I absolutely love the home office deduction for a small business that doesn't have an office outside of the owner's home. If you use this perfectly legal tax deduction, it's an audit red flag though, because it is abused so often. Oftentimes, business owners will try to sneak personal expenses into the deduction as well. If you take the home office deduction, please be sure to allocate your expenses between personal and business use. Unfortunately, taking the home office deduction is a little trickier for an S corporation. As you know, the IRS has very specific rules on everything, and of course, the home office deduction is no exception. If you have an S corporation and you want to know more about how to deduct home office expenses, please watch the video in the upper left of your screen. See you next time.